Mike Collins, your reaction, sir?
Yeah, John, I think this continued really strong labor market data is a little bit of old news, as Anastasia said, looking out 6, 12, 18, 24 months, which is what, good long-term investors do. I think it's going to be a very different picture, right? We are going to have a landing. The big question that you and we are all asking ourselves is it a soft landing / maybe mild recession or something much worse? But either way, I think earnings are coming down due to profit margins, demand coming down. Yeah, the service sector is robust. Business travel is back. Restaurants are full. Planes are packed, right? So that's a good tailwind. This reopening trade, not only in China, but in the U.S., I think has some legs to it. So there's definitely some credence to the idea of a moderation in growth from here. Maybe we get, 0 to 2% GDP for the next year or two. I think that's a really good outcome. I think that brings inflation down into the 3s. It probably leaves the funds rate near 4, not 5, right? So I think to Rick Reeder's point, I think 5.25 is going to be a big overshoot in retrospect, and the funds rate will ultimately land somewhere lower than that.
Mike, I keep hearing short and shallow. What are the assumptions that underpin that assessment? Where does that come from?
Yeah, a short and shallow recession, John, just assumes that, corporate earnings come down a little bit, but they don't go to negative 10% year over year next year. They go to 0, right? And default rates don't go to 7 or 10%. They go to 3, 4, or 5. That's and the unemployment rate goes from 3.5 to 4.5, not to 6.5 or 7. Those are the two scenarios we're dealing with. I mean, unfortunately, the probability of each of those two scenarios, the soft landing and the harder landing, are, I don't know, maybe it's 50-50, right? I mean, I actually think the soft landing is a very probable scenario, but in either scenario, you end up with a lower interest rate structure than you're dealing with right now.